Hi everybody, welcome to another update on the stock screener. This morning I saw this tweet about who is the next 98% loss silver producer. And they said that the first three are paid pumps. Could be, but I know that this one is going bankrupt almost. This one is 50% overvalued. This one has prospects, but the costs are pretty high lately. And then they say Andean Precious Metals has no debt and 90 million cash plus securities. Okay, so let's see. I'm intrigued to look at Andean Precious Metals. I haven't looked at it yet. Let's see if this is a good company. So I got a 1-year chart here and it's flat. Well, at least it isn't going down, so that's already very good. Looks like it's bottoming out. So how do we do this? We always look at free cash flow. That's the only way to value a company. How are the cash flows coming in after tax, interest, and capex? So I'm searching for the presentation. Let's see. I have got my NPV chart ready. Has a Bolivia company, tax rate 32%, mining royalty 7%. Not sure what kind of royalty. Bolivia. Okay, so we can already use this number 32%. Royalty, I will just deduct it from the revenue. 7%. So let's just times 93% to deduct the royalty. $84 million in assets. Let's check that. I have the financials. So it's in US dollars. 105 million. No liabilities, 14, so a lot of cash. So 90 million working capital, 90 million. And here, reclamation, which is not really debt, but let's just add it in there as well. So 70 million in net cash. Okay. 70 million. Let's just put it all in CAD, I mean in US dollars. Like this. But the share count, so this is correct. They have a lot of cash. Okay, so this is an old infrastructure from 2008. The grade is a bit low, 120. That's not high grade. 5 million ounces production of silver. So we could already say 5 million. Silver production. Yeah, this is low margin. The operating costs are pretty high compared to the revenue. First red flag. So they are supplying some of the ore from somewhere else. So the costs are pretty high because of that. And then they have this plant. So they source about 45% of that. And we also knew the grade was 120. 3 years mine life. That's not a lot. And then some state mining company contracts. But I wouldn't bet on that. That's too far out. And here studies ongoing, so we don't know anything yet about this. So yeah, that's the first problem. It's only 3 years mine life. 6 million ounces. Six million ounces. Didn't they produce 5 million? How can they have 6 million ounces and produce 5 million? It doesn't make sense. Yeah, probably be because the ore is sourced for 50%, so probably 2 million production from the mine, and then for 3 years we'll give 6 million. So yeah, it's a bit of a problem, the mine life. They want to produce 5 million. And it's going to be acquisitions. And we all know acquisitions to grow is not the best way. Shares outstanding 158.6. So enterprise value is this plus this times share price. Share price is 0.582. $22 million enterprise value. Why isn't this going up? Not sure. Yeah, why is this 5 billion? Okay, 22 million. Even Eric Sprott is in on this, 13%. I have a problem with this company because we don't know anything about this. So let's see, and they also don't have any costs data on this. So not sure what's happening here. I don't have enough data. So the only thing I can do now is look at financials. First quarter report. Revenue 23 million. Pretty high cost. Net loss. Net loss. Don't like to hear that. MD&A. $1 million production. So lower production than the guidance. All-in sustaining cost is 24.27, which is higher than the guidance. So we have problems. Very high cost, 24.27. And production is not 5 million. It is actually 4 million because the first quarter was 1 million. So let's take 4 million. They say 4.8 million, but I don't believe them. And between $20 cost, but it's 24 in the first quarter. Capex 8 to 10 million. So let's say 10 million. And are these US dollars? Normally this should be US dollars. Yeah, US dollars. So capex of 10 million. Interest payments. We do have interest. No, actually not, because there is no debt. So only 400,000 per quarter, so 1.6 million. 1.6 million. So there's no debt. Okay, I think we have a preliminary assessment on the capex. We have production, we have AISC. Okay, the silver price. We need to use the silver price, which is around 24. And there we have it. Negative. This company cannot make money. Let's say we go to 26, maybe something happens. Nope, cannot make money. 28, cannot make money. 30, can still not make money. 32. Okay, so at $30, they can make money. I mean, I don't like this company at all, especially at 24 silver. The costs are 24. Yeah, they say that cost could come down to 20, 21. Let's say 22. Yeah, it was 24. Let's say it goes to 22. Then still they can't make money because there's so much capex involved. If the capex was 0, then still they can't make money because the margins are so low and there are royalties on that revenue of 7%. It's not looking good. Let's see what they have more. Maybe they can surprise me. Yeah, they do think they can go to 20. Yeah, let's say 21 then. Just going to go by what they say. And even then, we don't have any cash flow. Right? So what are they producing? 978 silver and gold. I could break it down a bit. Let's try it. Gold is around 1960. And we have gold production as well. So let's split it up. Silver production is 978. 978,000 times 4. Yes, 978,000 times 4. And gold is 234 ounces. 234 times 4. That's interesting. It's a pure silver company. It's a pure silver company because they produce the most silver and just a tiny bit of gold, 1,000 golds per year, as you can see here, 1,000 gold per year. That's about 100,000 silver. That's not a lot. I could play around with the numbers. So revenue is this times this times this. C11 times C8 times C13 plus this times this times this. So about 90 million revenue. That's correct. If you do this times 4, then it's about 90 million revenue. And the costs are pretty high, almost the same as the revenue. And you can see that here. CapEx very high, 10 million. This is something that nobody talks about. Very high CapEx. And royalties. Also very low grade, 106, lower than the 120, so the grades are declining. Oxide purchases, Palacos, stockpiles. And here are the capital expenditures. 563, 563,000. That's 2 million per year. Why is it so low here? It says 500 only, 500,000. But here it says 8 million. Yeah, this is growth project. So only 500,000 and 8 million. Yeah, maybe I can decrease the capex a bit for the next years. I don't know, to 5 million. But for this year, we have 10 million. Even then, it's still a bad project. Free cash flow negative, 5 million. Not good. Last year it was 2 million. So 10 million free cash flow per year. Even if it's 10 million, okay, an enterprise value 22. That's 2 times free cash flow, not bad. But for this year, it's not looking good. And you need to know that it's only 3-year mine life. 3-year life. So something needs to happen to extend the mine life. Not good, eh? 21 per ounce, and last year it was 16. So costs have gone up very fast. Lower silver produced, higher milling costs. Not good. A lot of inflation. Lower tons purchased. And here, their own mines, Palacos and Cachi, had a grade of 53 grams per ton. Last year it was double. So their own mines are just depleting like crazy. And there are blockades. So the tons purchased are lower due to blockades. Okay, that's political risk. Not good, what I read here. Lower grades. Grades dropped in half. It is a pure silver producer, so if silver spikes to 30, 40, then that would be very good. The problem is if silver spikes, then also the cost will spike because they are purchasing ore. So I don't think this is a highly leveraged silver producer because they purchase the ore, which is a problem. This is not like a normal mining company. Their own mines are going to go out of business and they will need to source the ore and do acquisitions. So even though this enterprise value is cheap, it's cheap for a reason. High costs, blockades, lower grades, end of mine life, net losses, free cash flow negative, need to have high capex to do those new projects. So this is going to decrease the maybe 5 million. But 10 million is going to deplete the cash. Production is not as they say. All-in cost is actually 24 instead of 21. So they will probably lower guidance at the end of the year. A lot of bad red flags. Only see negative earnings. Revenue is going down from 28 to 23. I see more net losses than income. And it started at 38, see? 38, 36, 30, 30, 23. Revenue is dropping like flies. Net income is turning into net losses. And they probably need to close the mines. So provisions for reclamation, 20 million. That's why I put 20 million in the enterprise value as well. Because they need to close the mines in 3 years from now. And that costs money. Troublesome company. Cost of sales too high. They cannot make any money. AISC 24. Yeah. Even EBITDA 1 million. 1 million EBITDA, so 4 million. 5 times EBITDA. Okay. But a lot of capex. Depreciation. It was better last year. 30 million EBITDA. And now it's only 5 million. 5 million EBITDA. And then you need to pay taxes and capex. No, it's not looking great. Free cash flow negative. It was 2 million last year, so 10 million per year free cash flow. need to pay taxes on that, but now it's negative. Even if they ever get back to 10 million, it's still 7 million, maybe 5 million after capex per year. Enterprise value of 20 million. So it's 4 to 5 times PE maybe. That's good, but if they can get back to last year, it's still fair value. But looking at the numbers currently, it's not looking good. Grades are crashing. So, conclusion, I am not impressed. And I'll see you in the next video.